Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges, taking a look again at why IV matters, why implied volatility is the most important concept when trading options. Taking a look at SanDisk, which reports earnings early next month, but why now is an opportune time to short long-term IV as the recent huge spike in IV has also manifested itself in the long-term options. We're going out as long as we can on this particular trade. So let's jump in and take a look. As always, we use our fusion approach, taking a look at fundamental, technical, and most importantly, implied volatility analysis. So from a scanner viewpoint, here is SanDisk that hit up on the unusual option activity scan. You can see over 350,000 contracts traded, basically double the normal volume of 180,000 contracts. More importantly, implied volatility at 100%, which means options have not been this expensive over the past year. You can see earnings due August 5th. We're looking for, even though earnings are coming out, normally implied volatility stays in there, but this isn't really earnings related. It's the fact that SanDisk and these AI related names certainly have seen unusual option activity, more based on the fact that whether or not you believe in AI or not. But we're starting to see a little bit of pushback on that, certainly on the price chart. And we're seeing the stock, which was overbought not too long ago, now reaching oversold levels, but strengthening. So we're looking for really just kind of a flattening out on price and a come down, right? A reversion in implied volatility that has skyrocketed even more than the stock did. So from a valuation perspective, we always like to look at fundamentals. You can see that the stock reached hugely overvalued levels not too long ago, right? Here is the price to sales, which reached over 24 briefly, almost hit 25, but has pulled back and now is tempered to still 15, still rich, but not egregiously so here. Here you can see over the past 10 years, and SanDisk really has been around. They spun it out about a year ago or so. So it's basically kind of in mid-range, right? That yellow kind of signifies mid-range as far as valuation. Same thing with PE, which was trading at almost 83 at the highs, right? Now is tempered back under 50 times, right? Not near the lows back here, right? But well off the highs. And again, valuations pretty much neutral. We look for that to kind of maybe hang out here. Finally, that rip and then dip and then sideways bleed out is normally the case. As we like to take a look at the technicals here, you can see the stock not too long ago, about a month ago, was overbought, right, as it reached fresh new all-time highs, right? 9-day RSI well over 70, right? Bollinger percent B over 100, MACD at extremes. You can see it reached basically oversold levels, right? 9-day SR at the lowest level we've seen over the past 12 months. MACD also at the lowest level as well. Bollinger percent B briefly went negative and is hovering around that zero level. So the stock went from overbought to oversold in a month. So I think we'll continue to see this kind of chop, but really going nowhere, which sets up ideally to take advantage of this. The implied volatility has absolutely rocketed to fresh new all-time highs, and we'll take a look at that in a closer detail in just a second here. So taking a look at IV, as we said, you can see IV. Here I pulled off the 120-day IV over the past year. You can see again making a fresh new high over the past several days across the entire term structure of vol spectrum. Implied volatility, as we said, at 100%. In other words, it's never been this expensive. What does that mean? Option prices have never been this expensive either. Hard to continue to push that higher, right? This move here, and we'll take a closer look at the even longer term IV in a second, right? Hard to push it higher. Here you can see a look over the past basically month, right? IV, which had been averaging just under 100 over 150. So a 50% rise, basically. June 18th, it was trading 106.5, and this is a kind of generalized IV across the term structure, right? But you can see that huge run up, right, to now over 150, all because we saw continued unusual option activity. So I'm looking to go out as far as we can. December of 2028, you can see IV out there is 114, which is unusual to say the least. Pulled that off, right? The IV on these options to start July was under 110, last 111.5. You think that's not too big a bump, but on long-term options, increases in IV have a much more pertinent effect on prices. Here is a longer-term look at implied volatility on a 360-day, right, the longest ones they have out there on this particular chart. 70 delta call. These are the ones that we're going to be using as part of our trade, the 70 deltas. You can see it's just exploded to fresh new highs here. Not long ago, it was trading under 100, right? But the recent AI kind of malaise has ripped the IV in SanDisk to fresh new all-time highs. We look for this to revert. This is more of an IV reversion trade more than anything else. So that sets up a trade idea. So I pulled off a comparison, right, going back again to May 15th. And if you take a look at the chart, here is that kind of comparison date. Stock virtually at the same price. We've come back to this level and compared the straddle, right, the long-term December of 2028 straddle to where it was now. So on May 15th, right, basically 2 months ago, the 2,340 straddle, right, was trading just under 2,100 at 2,089, right? IV hovering just under 100 IV, right? So even though this is probably the most interesting thing, even though the stock was at 1382 back then, and the calls were about 1,000 points out of the money. The puts about 1,000 points in the money. The delta on the calls, right, was about a 70, a 69. Delta on the puts, a 29. So even with the puts deep in the money because of the high implied volatility, even back then we've gone much higher recently, right? So we're looking at the implied volatility going back to May in this area here, right around 100, right? We've shot up even more since then, right? That gives the, call delta a kind of artificial boost in a way, if you will. So even though the calls are almost 1,000 points out of the money, right, and the puts almost 1,000 points in the money, the calls carry a much higher delta because of the high implied volatility, the long-term nature, and the upward drift factors. So back 2 months ago, that 2,340 sell straddle was priced at 2,089. Fast forward to Friday's close, that same sell straddle, right, selling the 2340 December of 2028 call and put both has exploded to 2,242. So even with the stock dropping a little bit, the stock moving from over 1380 to 1354. So basically you had the stock drop almost 28 points, the straddle increase 153 points, moving from just under 2,100 to almost 2,250, right? The delta on that also expanded. Why? We saw the stock drop, but it become a net more bearish trade because the implied volatility exploded by 15 vol points or over 15%. More importantly, as we can see, 64 days, 2 months pass, right? You'd expect some time decay, and certainly the theta on this trade well over 70 cents a day. So you'd expect to make money from time decay on this. So kind of pulled it all together. The expected delta gain, right? You'd be about 45 deltas net short on average, right? With a 42 delta on the trade with the IV at a lower level, selling a 69, selling a negative 29, right? So you're looking at right around a 40-ish delta, and then that explodes, we said, to a 48 delta, right, where it's 73 now, right? Even with the stock dropping, the call delta increase. Why? because you saw that huge jump in implied volatility. So the delta, you'd be about 45 deltas or so net short, the stock dropping almost 28 points. You'd expect that sell straddle to drop in price about 12.5 points, right? Time pass, we had 2 months time decay, right? And you're making about 70 some cents a day, right? For 64 days, you'd expect over 45 points in time decay. So you'd expect a very nice combined gain there, right? Of almost 60 points, right? But the actual loss on the trade, right? Because the sell straddle increased in price by 153, gives you a vol edge of well over 200 on the trade. You can see that before with the IV at much lower levels, just under 100, your upside break even 44.29, your downside at 251, right? Then fast forward to Friday's close, upside break even now approaching 4,600, right? You have much more upside, right, cushion. Downside is under 100, much bigger downside cushion. Why? The straddle increased hugely in price, right? All because of this IV pop here. So all we're looking for, again, by putting this trade on is some reversion of this huge run up in IV. Earnings are coming out. It might happen before, certainly will usually happen after. We shall see and keep you informed on that. Interesting note here, I just went on and said, you know what, let's take a look and see if we can get a bigger cushion, right? The nice thing about a jump in implied volatility like we've seen in SanDisk, you can get further out of the money for the same net credit. Exactly the case here. So you can have sold the 3,000 call instead of the 2340. So pick up 660 points more upside cushion. The 2200 put, right? Pick up 140 more points downside cushion and get the same net credit as you would have back in May 15th before all this huge run up in IV happened. So that's the trade we actually did today, right? That has 140 more points of downside cushion, 660 points of upside cushion, right? Because we're able to make it not a sell straddle, but a sell strangle, selling the 3,000 call, not the 2340, the 2200 put, not the 2340, right? So a much bigger cushion on both sides gives you much bigger upside cushion, upside break even, over 5,000 now, downside break even on this trade, 153. So plus you have all the shorter term, right? You're as far out in time as you can go to sell spreads against it to hedge if you don't get that IV reversion. So that's why we elected to take this one. We can continue to chop wood, as we like to say, right? And when you look at SanDisk, certainly there are so many different short-term trades out there that you can take advantage of. Look at all the weeklies, right? And we're looking at going out to December of 2028. So you have plenty of ammo to hedge by selling short-term put spreads if the stock continues to maybe rip higher, right, without reversion, or even out of the money call spreads if the stock happens to drop. But remember, our trade is bounded to the downside, right? Selling this sell strangle, right? 153 is our downside break even, so you wouldn't mind probably owning SanDisk, which is trading at over 1,300 at around 150. So Theo, look here, I always like to say, okay, let's just see what happens if we get a just 5-point vol reversion, right? So moving here from the current level right around 115 back to 110, not looking for it to go back here at all, right? But just a simple pullback to the recent run up here. What would happen to the trade? You can see the Theo would increase. You'd make about 70 points on the trade just by a 5-point vol reversion. Interesting to note too, currently, like I said, you're about 46 deltas net short. A 5-point vol drop, you'd only be about 42 deltas net short. That's the effect of a drop in implied volatility on deltas out here. So we actually did the trade today. Here it is down here, selling one of the December 2200 puts, one of the 3100 calls, right, for a 2,057 net credit, right? The stock was at 1403.26 at the time. This is time in sales, able to capture 113.5 roughly IV and be 44 deltas and hedge short. Margin requirement on this to do one, just under 30,000, so it does require a fair bit of margin, right? And you also need the highest option approval level. So we'll see what happens with this one. Basically looking for this huge run up in IV to temper, right? And if the stock drops, even better. And certainly post earnings coming early next month, we should see that reversion. So until next time, as always, here's the good trading. Take